Morning, everybody. Good to see you all. And we are also expecting students from other cohorts to join in, but I think they can't make it because of scheduling issues. But it's my absolute pleasure and privilege to introduce to you Sriram Mahadevan. I've got to tell you a bit about this guy and close the year, Sriram. So this guy, by the way, is part of the Azim Premji Foundation. So Premji Invest, for those of you who are interested. They manage an enormous amount of wealth. $12 billion plus? $35 billion. So I was just off by a factor of 3. So manage an enormous amount of wealth and asset allocation. And a close personal friend, somebody I speak to quite regularly on markets, on views, etc. And somebody whose views I value a lot. That's the part you're supposed to close your ears to. So I had mentioned to him that we've got this course of FICM and DRM going through, and that I was looking for people who might be interested to speak. This guy actually offered to fly down from Bangalore only for this. So he had absolutely. So his point was he had something between 23rd and 25th of June. He said, after that, you tell me the date, I'll fly down. So 28th, I told him the date based on our commitment, our convenience, the classes being available, and he's put a trip to Bombay just for this. So this wasn't a trip that we fitted something based on an expected trip of this. So thank you, Sriram. That was. Between him and his colleague, somebody called Lan, and a whole bunch of people, that ecosystem in Azim Premji is amazing. They have an Azim Premji University, which has some of the sharpest thinkers, economic thinkers in the country. These guys actually convert those thinking into action in terms of investments, etc. So it's just an amazing ecosystem. So what I've requested today of Sriram is the following, that he will speak to all of us. I've asked him to roughly cover the following. One is about Premji itself, what they do, how they go about their entire investment philosophy, including things like asset allocation, including things like individual investments, risk management, how do you actually review, value, and look at your investments. Some of this will also be relevant to your other courses that you're doing, including on securities analysis and portfolio management, etc. By the way, our friend Naren co-takes, it's SAPM, right? So securities analysis and portfolio management, along with a professor of ours, Hemant. The two of them jointly. Yeah, so Naren, he's been taking this for many years. Naren is, by the way, part of the clique out here as well. So it's something, it's his passion. He comes down here, he brings his fund managers as well. And I think I would have given my right hand to actually go through a session with Naren earlier. Anyway, so tell us a little bit about what you guys do for a living, how you measure, how you invest, how you take a call, and so on and so forth. Second, I would really want you to tell us a bit about markets, your worldview of both economics and markets, both at a world level as well as an India level. So what is happening in economics, what is happening in markets, including currencies, commodities, interest rates, equities, of course. So that worldview. And finally, of course, we've got a bunch of ambitious young people here, some of whom have told me that they want to go into markets. Their misfortune, but and even otherwise, they will all become hopefully CXOs in the next 10-15 years, maybe even before that. And they will have to worry about risk management and investments and borrowing and so on and so forth. So if you can give a broad overview of careers in financial markets and in this particular ecosystem, I think that will be of interest to them as well. They're all money-minded people. They want to hit there pretty fast. So thanks once again. Thanks a lot, Sriram, for this. We will. The floor is yours. As much time as you want. Thereafter, we'll have a Q&A session. No questions have been planted. I can assure you that. So if these are good questions, I take credit for it. If they're dumb questions, it's their problem. So, but the floor is yours, Sriram. Thank you so much again.
You've got a bit of Bangalore traffic and Bangalore weather. I am Sriram Mahadevan and I represent this organization called Is the Mic On? Audible now? I am Sriram Mahadevan and I represent this organization called Azim Premji Fdn. Foundation is a cluster of a couple of NGOs. One is an operating NGO where we kind of work to improve capacity building in government schools. So what we do is we kind of teach the teaching system in government schools. It's a very large landscape, covers about close to around some 7 to 8 lakh schools. Probably the kind of schools that some of us may not relate to. Pretty much in rural areas, and some of those schools are even characterized by a single teacher, if not 2 teachers. What happens in a evolved ecosystem in cities is that you always hire somebody new and you kind of handhold them onto the process. Some of these schools may not necessarily have that luxury. Teacher kind of goes through a government training system and then kind of within 1 month or 2 months, she's deputed onto the school. So she hits the road running. So we work in that ecosystem to kind of help improve teaching. It's a very upscale initiative. Currently, we have presence across 58 or 60 odd districts across 7 states where we have presence. We always pick a state and a district from the most backward area and then probably kind of expand. It takes its own time to kind of scale up. As you know, good teachers are very difficult to come by, and trying to identify teacher trainers are even more difficult. You can't kind of poach teachers and make them teacher trainers. I don't think government would kind of like that model where we kind of hire teachers to come at schools. So we need to look for endogenously developing that kind of talent. So it takes its own time. It's a slow process. So that's where we are. We also have a university which focuses once again largely on coming out with better quality teaching talent. So we don't have it's not a B school, it's not a engineering college. It has all the other economic streams, other art streams, policy, liberal arts, but largely focused on coming out with better quality, push the ecosystem. So this is what we call as an operating NGO, where we kind of roll our sleeves and do it ourselves. Second part is a grant-making organization. The grant-making organization identifies areas outside education laws, and we provide pure financial grants. It's not impact investment. We don't do return-seeking investments. We look for returns only in the form of societal. So you can say kind of donations is what we kind of work with. We work largely with private sector NGOs and also with some government initiatives. So these 2 organizations, if you look at it in a classic way, they are dependent organizations because perpetually there is no endogenous money. The entire service that we provide to the government is provided free of cost. So to that extent, these organizations have to be funded, all the salaries have to be paid, all the expenditures have to be incurred. So the endowment was set up about a decade or more ago. The endowment was set up where he transferred a large part of Wipro shares onto the endowment, irrevocable transfer. So that's how it started. So we were endowed with Wipro shares to begin with. Then over the years, he's transferred more and more. So currently, the economic wealth of the organization stands at about $34 to $35 billion. There was an organization called Premji Invest, which initially started as a wealth manager for Mr. Premji. So they kind of used to manage a large slug of capital of Mr. Premji. Sometime back, a large part of the economic interest of even Premji Invest has got transferred to the endowment. So the endowment broadly manages 3 streams of capital. One is the wealth in the form of Wipro and the unlisted business, the consumer business of Wipro, which comes to us, the economic benefit from that, to the extent that the interest is paid to us, that comes to us. Second is Premji Invest. So Premji Invest currently manages about roughly around $10 billion in capital, vertically split largely between public and private equity. That kind of comes to us as economic benefit. The third pool of capital is what we directly manage at the trust. So here we look for investments which don't necessarily overlap this because there's no point in me trying to replicate a strategy which is being done downstream. So we look for strategies which are quite distinct. So in economics, you call them as completeness portfolio. Try and fill those gaps which are there. So we look for strategies like distress investments, special situations, real estate, fixed income. Those kind of come and so even in equity, we look for those strategies which are very distinct from what trading investments is. That's pretty much the organization. Our team is at a trust level, we are only about a 6-member team which manages the money. But this money is being managed in a very passive way. We are not active traders. We look for partners who kind of manage money. So hence we are not a very manpower intensive or trading intensive organization, unlike trading invest. So this is what we will mention. My journey, I started financial markets maybe a couple of years after Anand, but all of us are in a way peers. We were all in the markets when fixed income markets in India were born. So fixed income markets in India were not born when bonds were issued, right, which started way before. Fixed income markets to a large extent were born when fiscal dominance to some extent ended. See, what is a market? A market is something where you kind of allow markets to price assets the way they perceive risk. That's what it was. Prior to 94 or 93, you always had a system of private placement. So any auction of bonds, right, since there was a large fiscal dominance that India was saddled with prior to 91. Right? So you always had a backhanded handshake where government would decide to kind of sell bonds out to RBI at prices which are mutually decided. So this need not necessarily have a bearing with inflation. Inflation would be anything, but government would decide how much they can pay. And have you ever seen a system where the borrower decides what is the price at which he would borrow money? That's not real economics. So that is what was happening prior to 94. 94 is when they kind of said that we'll henceforth not do this. Let the system kind of price assets. We'll start hitting the markets. If there is a support required for the borrowing program, RBI will in turn join other market players in the market and buy the bonds if required. So the system changed from the direct handshake, which was happening then. So I would think the bond markets in India were broadly born at the point of time in 94. So whatever journey we have seen in the markets from, sometimes people talk about Indian markets are nascent, we are not deep. Right? I think it's a bit uncharitable because some of those global markets evolved, regulators stepped in only to kind of maintain orderly behavior in those markets. Indian markets are peculiar basically because Indian markets, regulators had to step in to develop the market and to maintain orderly behavior. So I guess regulators had to kind of take dual role in our markets. So 94 is when I would call that the bond markets in India were born. So whatever journey you see today is all that we have traveled from there to here. What was the second topic?
You finished about your career?
Yes, I started my career in 92. I started trading equities. Harshad Mehta's camp. I think some of you would be familiar. So we all started trading in the market, assuming that that's the only way to salvation, easy money. I mean, I'm sure all of us can relate to it. All of us want that. So we all kind of jumped in, traded markets, and things blew up. And then that was the best way. I would think that's the best investment I ever made. The loss that I made at that point of time. So I resolved not to trade in the market. So for next about 2 to 3 years, I didn't trade a stock. I moved into bond markets. Nascent stage in Indian bond market. So I was very fortunate to have made the entire journey from 94 all the way to date. It's very easy to kind of relate at this point of time, but that evolution was fantastic. Started seeing it from the inception all the way to date. So every regulation, I'm sure people like Anand can relate regulations right from the fact that why did they come into being first of all? That's the best part in regulations. When you kind of read a regulation, right? One part is about what it says. Second part is why did it come? Some people like him can even relate to that evolution. So we've kind of traveled it. After that, I joined a company called DSP Merrill Lynch. Merrill doesn't exist at this point of time. I mean, I'm sure that's pretty much the case in most of the good businesses at the point of time, right? Those wannabe businesses that we all wanted to kind of finish our schools and jump into. Some of them don't exist. Merrill was one such business. So I was part of the DCM, the fixed income sales at that point of time. 2004 is when I quit Merrill to join a startup. Yes, 2004 also we had startups. So I joined a startup at that point of time into financial services distribution. Good journey. The company finally ended in 2017, was acquired by a much larger business. But I quit somewhere in 2010 and joined this ecosystem that I've been part of. I relate a lot more to fixed income market, though I kind of manage multiple assets in this ecosystem. I relate a lot more to fixed income market. So that's pretty much my journey. I'm a CFA charter holder.
Worldview economics.
Worldview economics. So we were speaking about this debt, right? In fixed income, you always see the marginal incremental cost of debt always goes high. Imagine if I end up borrowing a unit amount of money and let's assume I pay about 10%, right? The extra unit of money slowly starts getting priced higher and higher, primarily because as I keep borrowing more and more, I get more and more risk. Right? For the same value of equity that I have, an extra leverage makes my capital more and more risky. Some of these things didn't work over the last decade or decade and a half, primarily because you had a situation where governments were borrowing money. Incremental cost of borrowing was effectively kept capped by central bankers. So it's like me having a side pocket and I keep issuing bonds and the side pocket keeps buying to keep the cost of borrowing lower and lower. So this kind of worked well primarily because all these days we didn't have an inflationary environment at all. Over the last about decade and a half, I think about 2 years back, we were even saying this Phillips curve doesn't work. There's nothing called monetary inflation. Right? We came to a point where these things don't work. Till the time it kind of bombed on our face. So I think somewhere we are seeing manifestations of those excess by way of now we don't see central bankers buying bonds as much as we used to. In fact, central bankers are going to sell bonds in some time. So it's like this side pocket which is holding all these bonds will start selling. So all of you know that bonds, unlike equity, have an automatic maturity. If I'm holding a bond for a certain period, at some point of time the bond matures. So what central banks hold by way of bonds do mature at some point of time. And if the central bank does not go on to reinvest in those bonds have to be funded by people like you and me. So now you will see it's not just the normal borrowing that probably the governments do which manifests in the market. We'll also see that one dominant buyer is not going to be there in the market anymore. So somewhere what you are seeing by way of interest rates going up, inflation going up, are all manifestations of those excess which happened over the last decade and a half, coupled with, of course, those few frictions that happened in the form of war and supply chain issues. When it comes to supply chain issues and war, in commodities, there are two types of commodities. At least you have something called as storable commodities and non-storable commodities. Storable commodities are something where you don't need to bother about incremental cost of storage. It's very easy to kind of keep producing irrespective of when it gets consumed. For instance, let's assume steel. You can keep producing steel as a process over and over. You don't need to bother about cost of storing steel as much. This may not be the case with, let's say, tomato or a brinjal. So a small demand supply imbalance on a given day or a given time period can create very huge volatility in prices in the case of non-storable commodities. So what happens is, so far as crude is concerned, crude is much closer to non-storable. There's a unit storage which you can have. Beyond that, storage in crude is becoming very difficult. In fact, 2020, we saw a situation where spot crude prices came to some negative $37. Primarily because while we were extracting, we didn't have a place to store. So I mean, you had a lot of buyers who were willing to buy crude, let's say 1 month out, 2 months out, 3 months out. But the tanker had to offload on that day. The tanker cost is a cost. So hence, it was available at minus $37. I don't know whether trades happened, but it was there at that point of time. So non-storable commodities are all characterized by huge fluctuations for a given period. Some of those markets also go into backwardations, which essentially means spot prices can be higher and forward prices can sometimes be even lower. If you look at even crude, logically speaking, you always pay a price which is higher in future, right? Because you have to have carrying cost also. When I buy an item today and sell it 1 year out in future, I need to also fund cost of storage. I also need to fund cost of holding the material for that 1 year. Right? Whereas in some of these non-storable commodities, right, you might just see today's spot prices might be higher because I need a tomato today. I need a crude today. Whereas in future, it might be available at a much lower price. So some of those markets kind of traded in backwardation. I don't know if crude is still in backwardation, still very much still in backwardation. So a lot of frictions in because of this war and China-related lockdowns, all these things impacted a few industries. But the other factor that also contributed to this situation that we are in is because of years of underinvestment also had happened. You know, thanks to this ESG factor, environmental issues and all that, capital providers started seeking higher and higher returns from sectors which probably have those impacts on the economy. For instance, the coal sector, right? You saw that anybody who's investing in coal sector will see that those things are getting more and more risky for me. Because government is now pushing more and more on environmental taxes, right? So the sector's cost of capital became higher and higher. So for almost about a decade or decade and a half, we found that that sector was characterized by a lot of underinvestment. So people started closing mines or incremental investment is not being made. So suddenly when demand supply gap emerged, we found that all these things also compromised to kind of reach where we are. Will this kind of continue? Difficult question. Because these are all the questions that would probably get us millions or billions of dollars. So I don't think we have a precise answer to some of these things. But these are the problems. So the question is, when will these problems kind of solve? Frictions can persist for some more time, because if a supplier of oil is around 6 billion barrels a day, which is Russia, right, is having problems in trying to seamlessly sell its crude globally, that will create a gap, because crude does not have a lot of spare capacity globally. OPEC spare capacity is very limited. So energy consumption is a very important need globally. So hence you will see that demand will persist, likely to persist, till the time you once again see supply outstrip demand for short term. Once again, you will see those cycles play out. US is expected to go into a contraction mode in some time as rates go higher. That's likely to happen. Let's assume 1 year out, 1 year out, 1.5 years out. As that happens, you will see energy demand kind of grow. Those economies are all characterized by a fairly matured level of per capita energy consumption. Unlike in India, where per capita energy consumptions are very low. So hence, even if we are not contracting as much, our energy growth always has certain trend. Those markets are all characterized by very high level of per capita energy consumption. So any contraction in the economy will clearly manifest through lower energy. So at that point of time, you might just see markets don't kind of wait for that. Markets start pricing some of those things ahead. You'll start seeing those frictions related to oil might start subsiding. Other commodities are concerned might take a bit longer. It's slightly complicated. See, which of what we are currently seeing through is something that we saw, let's say, 2 years back or 1 year back. The best of minds are not able to see what's lying ahead, say 1 year out, 2 years out. So why would I want to sit here and guess what will happen 1 year out or 2 years out? It's a very complicated thing at this point.
And some words about career prospects and your advice.
Yes. So how many of you want to join financial markets after that?
They're just saying this to make you happier.
It's actually quite nice. It's quite nice. Because you have a very diverse thing in fact. Sometimes when you kind of enter this market, all of you feel that you're managing money. You're managing markets, you're managing money. Actually, managing market is what you generally tend to feel when you start your career. I don't think any of us manage markets. It's what markets are. So all that we spend our time is to kind of manage expectations and temper risk. Right? And that to me is the largest element. See, the biggest risk in financial markets when you are investing in equity is not risk of inflation, is not risk of contraction or anything. It is risk of what you call as decision risk. Decision risk is risk of taking out money at the worst time. Because financial markets, all of us know, are cyclical, except for a few exaggerated valuation businesses which you buy, gold-rated businesses that you buy. By and large, most of the sectors and businesses are cyclical. So what everybody wants to own today. Suddenly lose flavor and then everybody wants to sell. It's like a seesaw. So it generally goes up and comes down. So that's pretty much the case with markets. All you need to do is to kind of bid its time, you will see that sector will come back. The thing that people always do is what they generally do in a train queue or any queues. Right? You always want to choose between which queue will go first. All of us know that the difference between Q1 and Q2 and Q3, right, is only a marginal 10-second or 20-second. But yet we all spend so much time in running from that queue. That queue is moving ahead. So if we just shuffle there and stand there, which is what people do in financial markets. The risk of taking out your investments at the worst time. People don't review investments at a good time. You're buying a stock from 100 to 150 or 200, nobody wants to sell. Because the performing stocks you want to own, right? So you always feel this linear trend will continue. So hence people don't review investments in good time, people always review investments at the bad time, worst time. So that's the biggest risk. So all people like us do is to kind of try and see if we can keep those biases limited. Otherwise, financial markets, nobody manages financial markets. You try and find out which pockets are coming to a point where valuations are getting reasonable, and then kind of identify those pockets at the bottom.
I'm going to ask you to let's grab a chair and maybe sit down.
Sure.
Get a nice chat. Just grab the chair.
Yeah, sure.
So I'm going to invite questions at this stage, but I can't resist asking you a few questions myself. It's table. Yeah. Again, I didn't prepare you for this, so apologies, but I'm going to ask some nasty questions to start with. So you gave us a worldview which is what I got out of it was it's complicated. It is commodity cycle, goes in cycles. US could go into recession next year. And you make the point that we don't really manage financial markets as such, a bit like what Eugene Kama kind of says. Here's my question to you, and this is specific to Premji investors. It's an unfair question. You do have to manage that particular assets under management. In a complicated scenario like this, how do you decide asset allocation at all?
Asset allocation is a very it's a nice thing to do in India. Global markets, textbooks talk extensively about asset allocation. Right? The basic tenet of asset allocation is to have as many assets on the table that you can invest as a spectrum, with a very conscious effort to understand what is their ex ante, right? Expectation of returns and expectation of standard deviation. Then you kind of mishmash, use various tools to identify. In India, you don't have many asset classes that you can invest. First of all, to even get into an asset allocation pattern, I need to have some historical trends or at least ex ante expectations of available asset classes with standard deviation and return expectations. It's very complicated, except for fixed income, right, which we can think of a benchmark. Equity, you have a benchmark. Beyond that, you don't have a benchmark for very many asset classes. Take real estate. Real estate, you don't have a benchmark. REITs have been in existence only for the last 3-4 years or 5 years. Alternates don't have a benchmark in India as such. So majority of the asset classes are not there. So we try and be a bit approximately right than we precisely wrong about these things. So we try and work with a name diversification. We do a percentage rebalancing with also regard to taxation, because in India tax is a giant deal. So you have regard to the percentage rebalancing. So in a very simplistically, let's assume if I have a 30 to 40 band for my equity exposures, and every time I kind of feel that the markets are exaggerated, I wait. As the percentage of equity hits 40, right, I try and rebalance it all the way back to around 28 or 29. So that I sell, not buy. To a large extent, I rebalance my portfolio. Similarly, when the market sees large drawdowns, I kind of take the exposure not back to 30, I take it all the way back to 40. So in a very simplistic way, we get bolder when the markets are selling, and we get a bit edgy when the markets are buying. But I would definitely like to kind of progress to a market which is slightly more evolved when it comes to asset classes.
Very useful. Specifically on a couple of assets. So let's talk about currency markets. Been in the news in the recent times. Touched 70, 79 yesterday. Now it's slightly below that right now. Your views on dollar globally and specifically on dollar rupee?
I'm not so much of a currency expert, but see, at the end of the day, at least my limited understanding is it kind of reflects an inflation differential, right? And that's what it broadly is supposed to kind of traverse. Globally, when there's a shock, you always see a flight of money to a safer currency. Just as you see a income shock, you always want to kind of preserve capital by taking it and putting it into a safer asset that you all relate to as safe. Okay? So similarly, there's always a tendency when globally when there's a shock, you always see a flight of money to dollar. Hence, you would logically see dollar strengthening, but that remains only till a point. This time looks like it can persist for a while longer, primarily because dollar as an asset is now yielding much more than before. Right? Coupled with this risk, you might just see dollar strengthen for a while longer, and especially with this global skirmishes remaining, it can be a bit more complicated to kind of gauge. I would still kind of bet on dollar remaining stronger for some more time before I feel that we are getting back to a more normal.
Therefore, where does dollar be?
Well, I would assume a year out, I would assume we should be closer to around 17, 17.
That's all. No big depreciation.
I'm not able to see anything beyond that.
Got it.
Visibility is all I have.
So one market which I know you're very comfortable with, fixed income. 10-year bond, 745-ish as we speak. What's your crystal ball there?
Well, my thought is, you speak to 9 traders, then you speak to a lot more. First of all, you look at Indian market segmentation itself. For us to call something as a market, you need to have a few conditions. Markets are to be liquid. Market should have various segments of players interact and trade. Indian markets are not characterized by those things. Are markets liquid today than what they were? Definitely, as they trade for larger volumes. But if you look at it, they trade for only about 2 or 3 securities. And out of some 78 odd securities in the market, 2 or 3 securities trade. 37% of government securities are owned by banks. 37 or 40 are owned by banks. 20 odd percent is owned by RBI. About 15-16% is owned by LIs, insurance companies, provident funds. So a large part of this fixed income market holding is being held mandatorily. SLR is what kind of mandates banks to kind of buy. I also have a choice of which duration I buy, but largely I'm mandated to buy. So this mandatory demand always gives a kind of a lower bound for rates. It doesn't hang too much beyond a point. Within that confines, right now, if I were to speak about 10, 9 are slam dunk bearish on interest rates. 1 I would think is neutral. So that gives us a reasonable courage to buy bonds. It's a good starting point to kind of say, look, when so many people are neutral to bearish, it's a good starting point. Terminal policy rates, a lot of this very interesting debate saying, where will Fed stop? Where will RBI stop? These are all very nice, fashionable things. A very seasoned investor once told me that equity as an asset class is very predictable in longer term, but extremely difficult to predict in near term. Bonds are exactly the opposite. Bonds are very deterministic in near term. Bonds are extremely difficult to predict in longer term. Right? Unfortunately, the fallacy of our market is we always try to do it the other way. Right? If you look at it, all of us want to predict where will interest rates be 2 years out, 3 years out. And we all want to understand where will equity market be next 1 week, 1 month. Right? So it's very difficult. Do I ball gaze where interest rates will be, let's say, 1 year out, 2 years out? You can always say, where is the market pricing to your curve? You can always say, where is the market pricing a 10-year bond 1 year out? But beyond that, do I have visibility on that? I would think it's a good starting point to start investing when majority of the markets are bearish.
So you would therefore put a lot more weightage on market positioning and
I would think at this point of time, yes, that does have an impact on. And then second is, Reserve Bank of India started using its tools. Right? You have, I'm sure all of you are aware of this inflation mandate, right? The 2 to 6% band. The 2 to 6% band and monetary policy framework is not to kind of say that inflation never crosses this band. It is to give a framework to get inflation back to this band. And that framework is at work. You have started seeing monetary tightening happening. If some of these things will start working as we go along. Financial conditions, not just in India, globally are getting tighter. And markets tend to tighten them much faster than policy transmissions. At some point of time, you will see some of these things will also kind of.
Excellent. Thank you. So you are bullish bonds.
I'm not as bearish as the market.
Not as bearish.
I don't think it's a good starting point to invest. See, when you are kind of managing a larger portfolio, you need to also have regard to, it's very difficult to be very precise about these timings. So hence you need to be a bit approximate. You need to kind of build a time for you to kind of use that capital. If you're managing about 100 crores, it's very easy to kind of switch in, switch off. If you're managing 1,000, 2,000 crores, it takes time for you to build, invest. So hence I would think it's a good starting point. If it goes to 8, I'll be happy. Goes to 8.5, and if I'm deployed at 8, I guess it's going to be tough.
Last one on equity markets.
Let's see, if I were to look at theoretical construct, right? 100 divided by 10-year bond yield should be your forward. Should be your forward multiple. Okay, in a very cool way. Let's assume 100 divided by 7.4 or 7.5. I think that brings us close to around 13.5 times. Nifty consensus earning expectation for FY24 is close to around 979. So it should be around 980 into 30.5. This is what you broadly call as fair value of the market. But market never trades at fair value. It trades along that. It's like a swing. It's a resonance. It kind of swings both ways. So basis where you are, you can start. Are we pumping our fist on? Are we being very, very attractive at this point? And the answer is no. Primarily because the entire basis thesis has changed from 5.7 bond yields where 1 year back. You are at 7.5. So you just do that 5.7 and see. You'll be able to relate to this 18,000 Nifty. And now you bring it down to 7.5. You might relate a lot more to 14,000 Nifty and not the current. But as I said, markets are never about fair pricing. I'll only say as investors, you can always see that's a good starting point to invest.
Thanks, Sriram. Questions, guys? Raise your hand and shoot. Yeah, go ahead.
If you touched upon this interest, the inflationary trend right now, it kind of brings me to a point where RBI just hiked rates and kind of brings us to the tiff between the central government's borrowing ban and RBI's plan to control inflation at that point in time. Now, say if as a consultant I've been hired by RBI and they're asking me suggest something as we want to get away with this tiff. How do you suggest that I think through this problem? I don't want a solution. How should I approach this problem and think about it, dissect it, and then go ahead?
See, RBI and government optically one from a market might think that they have divergent perspectives about it. I don't think the idea is correct. Both of them are in sync. To a large extent, they remain in sync because RBI has a longer term mandate. Governments have to seek revalidations. In India, we are in a permanent election mode. Right? You have state elections, then you have city elections, you have by-elections. So, hyperinflation or good high inflation is never a good starting point for any political party. So, at some point of time, there is a political cost that any ruling party would pay for higher inflation. Higher inflation gets stroked for a variety of reasons. Right? Sometimes people say higher taxes will lead to higher inflation. Actually, higher taxes don't lead to higher inflation. Higher taxes essentially means your fiscal contraction is at work. Right? Fiscal multipliers are negative. So hence, higher taxes don't lead to this. Lower taxes, higher spends will lead to inflation, which is very popular in government. If you look at any government would want to kind of borrow money and spend more on freebies. But then there is a political cost to it because if it manifests as higher inflation, you have a challenge of getting elected. So to a large extent, RBI and government work in sync. There are some portions where they kind of have frictions on the timing. I'm sure you've seen that they've been able to handle these things in a very mature way. At the end of the day, they all are part of the system. I don't think they've done something to rock the boat and bring the structure down on their head. So I don't think it is to assume that there is a conflict between them. But yes, where is a starting point right now? We are at 90% debt to GDP or let's say 87% debt to GDP. That's a good starting point to say. As globally rates are going north, to kind of have a high leverage is not a good starting point. So I would think government has done all the fiscal expansion it had to at this point of time. We've had through some very difficult 3, 4, 5 years. We also went through a lot of self-inflicted problems, which is dealing from global problems. For instance, we went through demonetization, we went through GST implementation. All these things also happened. So to some extent, our balance sheets at a sovereign level are what is weak, but our business balance sheets are very, very strong. Banking balance sheets are super strong. I'm sure Anand to validate that it resonates like in 2003, 2004, when banks have fully provided, businesses are getting better. So we are all primed for growth. If not for this, India would have definitely seen a much better growth. I don't think it's that complicated at this point of time. All that we need to see is to make sure that the borrowing is efficiently financed and the market kind of gets the risk premium that it needs. Because if you're borrowing a larger amount, it is very easy for you to kind of, if market is expecting a higher premium, you need to kind of give the premium to the market. Over a period, market will probably temper the expectation lower. But it's something where if free markets are to work, higher interest rate will itself kind of incentivize the government to consolidate faster. I mean, imagine if you are a capital seeker, if you are a borrower, if you keep borrowing unlimited money at the same cost, you will not have a disincentive to kind of deleverage. Right? So if borrowing costs go higher, then you probably have an incentive to consolidate.
Before I go to the next question, and let me know by raising a hand, I'm going to ask my own question first. So you mentioned about corporates having deleveraged. Banks are in very good shape now compared to 3 years ago. And actually the earnings of the Nifty companies, all the big companies have been extremely good, right? So 3,000 odd companies which are listed are doing extremely well. At the same time, your own Azim Premji University, Amit Basole, comes out with reports suggesting that poverty has gone up quite sharply and that there's the unorganized informal sector is in terrible shape.
Classic K-shaped recovery.
Classic K-shaped recovery. In fact, Pranjul, all these guys say 15% doing extremely well, bottom 40% doing. How do you see this evolving? Do you see the formalization, which is going through right now, dragging up the rest of the economy, or is it going to be the other way around?
See, we over the last 30-40 years, we've largely worked on the trickle-down part. It's much easier for the government to straight away put money at the top and then it kind of trickles down. Except in the last about a decade or so, when government has been very efficient in reaching money directly to people. So I remember, I'm sure we relate to this report in the 80s and 90s where they talked about helicopter money, where you effectively throw coins and it will probably reach people more efficiently than through a government administered system. So the leakages and inefficiencies were so high. Today, thanks to your direct benefit schemes and all, ability to reach those pockets are much more easier. Data is making much more efficient for people to kind of administer those things. So you would, at some point of time, I'll assume the top down is not just efficient work. You'll also see a combination of both. I don't think there's a need for incentivizing the top end. I think government has done all that it needs to do, and all the PSU bank cleanups and debt cleanups that's happened has happened. A large part of it, even the lower interest rate to a large extent, helps asset owners. See, who benefits from lower interest rate? People who own assets are the ones who kind of benefit from lower interest rates. So the transfer to the top end is more or less over. You will see a lot more administered schemes where government kind of targets benefits at a lower level. Longer term structural issues, see, at the end of the day, we are in largely an agrarian economy. When it comes to number of people who are employed, you need to lift so many people out of poverty. I'm sure I'm borrowing this from what you used to say, that if 40% of our country are employed directly and indirectly in agriculture, and if they all kind of contribute to 15% of our GDP, it means that they are so underutilized. So the best way is to make sure that you kind of push people out from that sector onto more productive sectors, and also increase the value add in agri sector. Currently, you kind of focus on basic items. You need to focus a lot more on processing, higher value add, so that you are able to kind of lift that many people higher up the value and also try and displace people from that sector by giving them opportunities in other sectors. That's going to take time.
So, again, if there are questions, just raise your hand. You guys are also very focused on education.
Yes.
Right? And I know Azim Premji himself is very, very focused on education. So one of the issues that we have on this 40% getting employed into, let's say, manufacturing, again, you have a K-shaped in terms of employment as well. Right? There's a shortage of skilled labor. You start a company and, ITI, not enough technicians. Wipro, the joke is you go to campuses and, hire in kilos, right? So, tons and tons of people you hire. But otherwise, if you look at the bottom 40%, then there's complete unemployability and it's simply, they don't have enough jobs. Education, do you see governments putting enough money now? Is there enough focus on education at all? So that skilled labor comes up eventually.
See, focus on education. See, education is a sector where change and transformation happens very slowly. So it's like you are driving a very large trailer and not a Ferrari car for you to kind of accelerate and stop. We are currently going through the best of demographic dividend. So much has been spoken about it. So the natural extension is that 20 years down the line, we might actually pivot that demographic curve. So the form of skills that we need to invest, the form of sectors that we need to invest in. India started by taking schools to villages. Right? We, for various reasons, from the time we started making sure that the schools reach out to students. So which is why we have that many schools and where we are. Maybe we do not require as many schools. You would see that progressively government will try and consolidate schools a lot. You might see that schools will get better quality facilities. You would see that they consolidate schools. That can happen. So the education landscape as what it was to what it is to what it will be, say, 15 years out, is also going through a lot of transformation. Technology makes it much more easier in certain spaces.
Is it happening though? Are you seeing improvements happening on the ground?
Improvements are happening. Learning outcome is definitely getting better. We're also trying to throw our bit to make it. A lot of people working. It's not. See, at the end of the day, it's a scale, right? So galvanization, measurement, all these things take its own time. It is happening.
So to that extent, again, I'm going completely off syllabus out here. 5 trillion economy, India becoming part of the middle income countries. Do you see that progressing at all?
So education definitely has a benefit. At the end of the day, see, not all is bad about education. You are a producer. you want pricing power, right? Inflation is also pricing power. So the element of pricing power is required. We will get there. I would definitely want to believe so. We will get.
Any other questions? Yeah. So go ahead.
So on the previous topic of education, so since you work closely with schools, how far do you think the new education policy, which was introduced last year, do you think it is inclusive enough? And if it is, does it have the potential to be effective in sort of vocational training and some of those focus areas?
Not completely on top of it. So I would kind of circle back on this. But I, from what limited understanding I have, is that you see a lot of connect with the industry to make it more relevant to what the industry has. You need to kind of bring it closer to the industry, try and find out what skills are used. But at the same time, education should not become completely job oriented. I mean, if I were to kind of ask a very crude question, since you are all sitting before an answer, are you here for knowledge or are you here for grades? Very difficult to kind of put a 0 or 1 binary answer. So you need to kind of bring it closer to the industry to make sure that there is a employment angle to this, but at the same time, it should not become completely employment oriented. Because knowledge should also give you an element of space to explore, a latitude to explore these things. So there is an effort in NEP, to my understanding, but I'm not completely.
On SPJMR specifically, I think you'll have to give a third option: knowledge, grades, or something else.
Okay.
We are definitely not interested in grades. Knowledge is questionable. Good question. On education, I'll quickly just add, and this is something that we discussed, in fact, in the larger forum in Wipro as well. Education actually is a state subject, right? So if you look at the outlay that states have put out for education over the last few years, it has gone up. So it's gone up, but not by much. So it's gone from about 2% of GDP to about 3% of GDP, okay, over the last 10, 15 years. And interestingly, it's across states. So even states like Uttar Pradesh, you see the numbers actually going up. Outlay is there now. How well it's getting utilized, I have no idea. But at least the outlay is there going up. In a funny way, and I hate to go political on this, but in a funny way, the focus on education in Delhi, for instance, has made an impact in other states as well. There are other states who don't necessarily like the political party in Delhi, but they're copying a bit of what Delhi is doing in other states. Peer pressure, or just the fact that this is it makes sense that it's a good thing to do, etc. Right? So that money is going up, but is it enough? No way. Also, another thing which has really helped is this midday meal scheme over the decades. It's really helped. Unfortunately, the last 2 years through COVID, that's been a big problem, right? And that's a big issue that we have to worry about. The fact, he'll know this better than I do, that the last 2 years, you had the luxury of having Wi-Fi and dialing in into a class. Many of the students across the country didn't have that luxury, right? So education has seriously suffered the last 2 years. Even otherwise, you will hear statistics about grade 5 students not being able to read grade 2 texts and all that stuff. So that issue remains. Long way ahead. I wish we spent as much time on education as we did on some of these social political issues that we see on Twitter, for instance. But yeah, it's a big issue. Sorry, there was a question here.
So basically, like the PMI numbers, the IIP numbers, like they've gotten better. But the recent growth numbers which came in, there were reports that it was majorly because of the low base effect that was there. And with inflation rising in, how do you see the RBI and government work together to, like, because it's a trade-off, either you can achieve growth or you can control inflation. So how do you think the economical outlook would be for India? And what could be in store, like what new measures or some existing measures that government or RBI could introduce to, manage the trade-off in a way?
See, raising rate is like hitting a brake. Right? So in a car, if you look at it, a brake is not something which always kind of slows you down. A brake is essentially what gives you the flexibility to even accelerate. You go at high speed, primarily because at any point of time, you know that you can always hit the brakes and kind of stabilize the car to a more sustainable level. So raising rate at this juncture, I would think, is more to give the sustainability. And see, inflation per se, as I was saying, is not bad. Predictable inflation is welcome. Right? The problem which you always have is with unpredictable income. Because predictable inflation, to some extent, gets into capital cost. Capital providers price it well. Right? They pretty much know what to expect. Right? Unexpected inflation should be kind of tempered to some extent. if your inflation can be anywhere between say let's say 2 to 10, very difficult for a businessman to invest capital. So the entire inflation framework, right, is primarily meant to give certain element of predictability. So what should government and RBI do? I think RBI is doing what it's supposed to do. It did what it was supposed to do. Phenomenal job. I don't think you could flaw them to say that they could have done this maybe 4 months ahead, 3 months later, 2 months later, but the jury is out. But from government's point of view, I think a lot more will be expected from now on. It's going to be very tricky for the government because they'll have to start doing fiscal consolidation. They'll have to tighten their belts a lot more. Faster they do, better it is. That would never be very growth supportive. So you would see that government expenditure would slowly start getting tempered at some point of time, or at least the revenue expenditure will have to get tempered. And keep in mind that a lot of revenue expenditure by government are unfortunately run rate expenditures. They are not those discretionary spends, they are those non-discretionary spends. Salaries have to be incurred, interest has to be paid. So they need to bring in much more efficiency into that segment. CapEx has to go. So both these will give stability from an economic perspective. And you would see that you don't need to raise rates as much as what you feared you would have to. And see, India's problem is not as bad as the rest of the world at this point of time. You have a 2% inflation which is targeted by Fed and probably a 8.5% which is manifesting. Now the journey from 8.5 to 2 is actually a lot more painful. So for us, we are off, but not that off. And inflation has a tendency to get to the base. So since you mentioned base effect, right? Everything in life is a function of where you start measuring it from. How are you doing is a function of how you were and what point of time you start measuring from. So this high inflation also gets you to the base in let's say 8-9 months time. So inflation statistically tempers down at some point.
Sir, could this thing of managing the trade-off lead to stagflation? Because like inflation is what everyone is seeing, but there are some analysts who feel that because the elections are coming in, so growth cannot be cut. They will have to spend, but inflation is going up. So like if the government decides that willfully they'll reduce the spending, can this translate into a stagflation kind of a mix where the challenges increase even further?
Not kind of lived through a stagflation phenomenon, but I think you're already there. If you kind of see what is stagflation, stagflation is higher inflation coupled with not zero growth but lower growth. Right? I think you're already there. Except if fourth quarter, I think you're heading for a growth rate which is much lower than inflation. So I guess you're already there. Will we kind of stay there for long? I don't. The honest answer is that I would want to kind of go there and then find out. Some of these things are very predictable. Quite a few of these parts are moving parts. For instance, frictional part of inflation is not something that we can forecast and say will last or not last. US growth fledging at some point of time, right? China's factories starting to roll, right? All these things will have its own impact on inflation. So I would only say as much as we didn't see this, what we are living through coming, let's say 12 months back. We don't precisely know what we will see 12 months out. So future is not predictable, but best is to start preparing for it. So it's always nice to kind of build in margin of safety. But Ananta's traded bonds much more than who may connect it. You always look at what is the margin of safety that a bond prices. If a particular bond yields so and so, it's a function of repo rate over the trajectory. Right? So you pretty much know how much of repo rate hikes are being priced when you see the bond curve or the swap curve. That's a good starting point. You can always say, look, repo rate up to say 6.75 or 7 is priced. So now where are we? So which means X number of rate hikes are already priced. That's a good starting point to start investing. Now will it stop there? As I said, long-term interest rates are very difficult to predict.
I just have two questions. So the first, I think in the earlier part of your talk, you mentioned about how you make certain grants and investments where you look at the return in terms of.
Grants are different, investments are different.
Yeah. Talk about grants where you measure the impact in terms of societal good. So I just wanted to know what sort of framework you look at. What's the sort of framework that you have when you measure that, and how do you juxtapose it in terms of your investments that you make for returns?
See, so far as investments are concerned, investments are very distinct. Endowment is very different from the NGOs at work. So we don't mix both, right? The endowment is a pure return-seeking investment arm that pays taxes, and the end money which we earn is what gets funded to this welfare. So we don't kind of mix those two. We look at broadly in India, you have to work with sustainable 4.5 to 5% inflation, right? And we assume that on a sustainable basis, we need to pay out about 5% to our beneficiaries on a long-term basis, not currently, but over a longer basis. So compound these two. It's not 5 plus 5. It's effectively 1 into 5% into 1 plus 5%. So you look at it, it comes to something like around 10.15 or so. That's the return expectation that we broadly have in mind for the entire portfolio. So this is between debt, equity, fixed income, real estate, all these investments that we make. So that's from the investment point of view. So far as impact assessment is concerned, is very different from every NGO. Imagine if I'm doing an impact assessment on, let's say, rail children, number of children being left in trains, right? Then it's a question of how many children we are able to reach, save, impact, how many of them are safely landed up in NGOs who kind of take good care of them. So every, like in private equity, right? You investing in a retail business will have a different metric when compared to you investing in a brick and mortar business. So every NGO at the point of giving a grant will have its own metric. So we'll measure it with regard to that metric.
So on education itself, my question is, what is the role that you see for the private sector to come in? And like at the foundation, a lot of what you do is non-for-profit. Is there also room for, let's say, for-profit work in terms of consulting governments and not only education, in general social infrastructure? And on education itself, let's say, as you mentioned, there are enough schools and access is there, but we are now working on quality for education. So what is the role that the private sector can play, and what are the skills that we can take from a management degree, and like, let's say we can do something?
See, there's a lot of work happening on designing teaching tools and trying to kind of galvanize teaching infrastructure better to orient it for better learning outcomes. There's a lot of private sector work which is happening. But then if you kind of look back at number of Nordic countries which have got fairly to a good maturity level when it comes to teaching infrastructure or learning outcomes for students, those countries are characterized by very strong public schooling system. So education to a large extent is a public good. So equality or societal distribution of that resource can best be achieved only if government owns and administers it. So I mean, it's so much easier to say, look, we can start another 1,000 more schools. But the fact is, I don't think that kind of reaches that box. It has to be owned and administered by government. So all we need to work is to find out how do we complement government to make sure there's no point in me starting another 7 lakh schools. They are pretty much there. So if you're able to complement the presence of those schools and to find out how do you galvanize private sector talent to make sure that the learning outcomes are more important, that will be a more sustainable. And as Anand said, education is one area which is kind of which is a central stroke state government policy, largely state. So you need the blessings of both the government to kind of make any transformative or transformational changes. Government is open, but transformations at that scale take its own time.
And so very quickly on what are the skills that we can learn from our management degree and translate into, let's say, working in public.
So try and work on a simple problem that we are trying to solve is at scale. How do I kind of reach that many teachers and improve teaching talent, design better quality teaching tools? How do I improve learning outcomes? Because your unit of focus for us, if you look at our problem, our unit of focus is a teacher, right? But learning efficiency of output is through student. Learning outcome is what tells us whether we are doing a good job or not. But our unit of focus is always a teacher. So how do you kind of blend these two and make it more efficient?
In fact, I have to tell you that, Sriram, that SPJMR focuses a lot on the social aspect.
Nice.
All of them spend a fair amount of time with an NGO. In fact, we don't have summer training precisely because of that. During the summers, they actually spend time with an NGO on some social. A lot of them work on education as well. So we hope that the students that we send out are a lot more socially aware, even though they go through a painful process of that particular internship. Any other questions from the side? So sorry, I saw you first.
you manage different assets in your portfolio, and so you have to have a view on each of them. So like, what are the indicators that you look at? And secondly, like, when do you act on that? So what are the kind of, say, are there any trigger points where you act on, say, changing your allocation from equity to debt?
Right. See, so far as equity and debt is concerned, I did discuss. Broadly, we look at where we see value. If there's euphoria, we try and rebalance lower. That's one way of looking at asset classes. Second is we do something called as a name rebalancing. We do a percentage rebalancing. The moment a particular percentage of a particular asset goes way beyond a tolerance band, when we rebalance, we don't bring it back to the top end. We bring it all the way back to the lower end. Which means, imagine if I hold a 30 to 40% band for allocation in equity, right? And if equity market goes up from 30, kind of market goes up by 30-40%, then automatically my 30 will go on to hit 40 very easily. When I hit 40, I rebalance it back, not back to 40, but I bring it all the way back to 30. So I would invariably try and sell higher. Similarly, when my lower end goes way below 30, I take it all the way back to 40. So that's one crude way. It's very approximately, but it's kind of worked well. That's one. Second is absolute value. So if you look at it, most of the asset classes are derived by fixed income. It's not derived from equity, it's derived from fixed income. So when on absolute terms, fixed income you start seeing value on a risk-adjusted basis, on a risk-adjusted basis, if you start seeing value, that's a good starting point to kind of say where should risk assets be priced. Real estate is a very different kind of an asset class, and especially when you invest in real estate in India, very different. So in India, you have, see, real estate globally. If we talk about single real estate, or portfolio is very different. But if we talk about single real estate, it's a very location-specific asset class. It's got a lot of impact. The location of the real estate is very important. Imagine when we all were working, we all relate to South Bombay a lot more. The Nariman Point and things. Today, I don't think there's very many businesses there. It might just come back, but at this point of time, we don't have very many business there. So the preference is now completely on to BKC. Right? So imagine if I had bought a building, let's say 8-9 years back, thinking that I'll earn rental income. I can tell you the last 7-8 years, rental incomes in those buildings have been declining. So forget inflation. The actual earnings from those buildings have been declining. So locational observations in real estate is a very important factor. Some of you would have definitely traveled overseas. A lot of you would have traveled overseas. When you go on to see a building, let's assume in Singapore or Dubai or Manhattan, right? You see a 100-year-old building. It looks, I wouldn't say as good as new, but it does look well maintained, right? It does look very clean, neat, because they don't kind of overuse the building so much. In India, I don't know whether it's clamor for space or sweating the asset more. So we kind of sweat the building a lot. We just need to go to the basement of a 10-11-year-old building and you would know what it is to, how much the building has aged. So structural obsolescence is a factor. Locational obsolescence of real estate is a factor. So when you are buying a single cluster of real estate, all these are factors. And then in real estate, the most important factor is also debt, interest rates. Because at the end of the day, commercial real estate is largely traded through what you call as cap rate. Cap rate is nothing but you do your Gordon growth model. D1 divided by cost of equity minus growth. Cost of equity minus growth is your cap rate. So when your interest rate goes higher, which is your KE, cost of equity goes higher, then your growth in rental income, net operating income has to be so much more to keep the denominator function lower so that the value expands. If that doesn't happen, I mean, take today's case. You are seeing that interest rates are going higher, cost of equity expectations are going higher. Commensurating with that, the confluence, worst confluence cocktail is growth expectations in commercial real estates are not that upbeat. Thanks to this work from home and whatever is happening, right? We are still trying to kind of settle where we need to settle. So over the next 1-2 years, growth expectations on commercial real estate rentals are not that robust. So you mix and match these two, it doesn't look that great. So we take some of these factors. Interest rate is a very major factor that we take into account because interest rates impact even PE multiples, it impacts real estate. Yes.
Sir, a lot of Indian companies borrow money from, let's say, US or abroad. So, sir, first of all, I want to understand how do they manage the risk that arises, because the rates there are cheaper, but then you will have to, you are taking a lot of currency risk as well. And now since the US rates are going up, so how now they'll come back to the Indian markets to borrow. So how do you see the impact of them borrowing from the Indian market impacting the overall interest rate market? Because that is what drives inflation also.
See, there's nothing called cheaper there and way cheaper here. These things are very marginal. Some companies tend to have earnings in foreign currency. Those companies tend to kind of borrow money optically there so that they can call them as natural hedges. I don't need to kind of incur the cost of hedging those resumes. So to that extent, optically you get a feeling that you are trying to save cost. But this is one question which I'm sure you have a much better placed person who's been handling this for the last 2 decades. He's best placed to answer this. But yes, sum and substance, this is where it is. Every market has its own cyclicality when it comes to risk appetite. Sometime back, US market was showing a lot more risk appetite on credits from India. So there was a lot of, and all of us knew that junk bond spreads in US contracted to the lowest. So it was becoming very attractive for Indian business to go there and probably raise money. Now that is kind of working against. So you would see a lot of some of those companies kind of come back and roll over their obligations in India. But where are we? We are at about hardly touching double digit at this point of time in credit offtake. We still have a lot of it to accommodate some of those businesses. And maybe at some point of time, if their leverage levels are measured, see, keep one thing in mind. Indian economy is just primed for expansion. We are not like US, which has seen a decade of very good growth and then seeing a slowdown after it. We have just done all the repair work and now we are starting our car, so it can drive fairly well for longer. So credit quality, right? Credit spread is a pro-cyclical bit. When a company does well, when the economy is doing well, companies' credit quality improves. When companies' credit quality improves, you would see that their ability to finance is reasonably easier. When companies are going through a bad patch, credit quality is poor. When the economy is going through a bad patch, credit quality is poor. So if our economy is set to expand from where we are, I guess it should be a reasonable expectation. Though you end up paying a higher price, but it should not be that difficult. That's my view.
Makes a lot of sense. Okay, I'm going to ask you a question which some of them might want to ask but are shy to ask. They'll be approaching interviews very soon for autumns, and then finally, of course, next year they'll go for the finals. How should they prepare for interviews in finance, and in particular in markets, in case they're interested?
The markets are a very wide place. Sometimes everyone kind of relates a lot more to equity market. The equity market is very easy to explain. But I can tell you there's as many opportunities which are available in fixed income, as many opportunities that are available in wealth management. Wealth management kind of see where we are, right, to where we'll head over the next about decade or 2 decades. It's a huge journey. Will it be tech enabled? Will it be manpower driven? Will it be your focus area? See, look at the number of entrepreneurs that India today has. All these entrepreneurs will start throwing cash flows at some point. Maybe another 4 or 5 years down the line, some of them will start generating huge amount of cash flows. They will require solutions on how to kind of plan their investments. Forget entrepreneurs. I mean, take my dad. My dad worked for almost about 20 years to buy a house. Right? So 20 years of savings, then buy a house, and probably he repaid a loan for next about 7, 8 years or 10 years. Look at me, I bought my first house and then started repaying for next about 25 years. So the models have changed. Their models were slightly more stable. Our models are slightly more fragile. Retirement about 20 years back, because government was the largest recruiter. Retirement was a function of age. You can work till you are 15 or 16. Now retirement is a function of being financially prepared. Sometimes some of you might aspire to start an NGO, or some of you might aspire to start your own business. So quasi extent, that's also a kind of retirement because you don't have stable income. So hence a lot of people will require very well thought through financing solutions to find out how to kind of mix and match these objectives. So I think that requires a lot of specialized skills. Will tech kind of enable such solutions? Will you still require human touch? That's a $1 million question. A lot of tech is also working on that space. I think that those spaces will open up a large canvas.
So wealth management, markets, and of course equities as well. Again, what would you look for as qualities if you were to interview somebody for a wealth management, for instance?
You see, banking as a business, right? A large part of banking as a business is all about KYC. You need to know your customer a lot, what the customer wants. See, there are two conflicting things when you kind of interact with the customer. A customer very often wants certain things, but you as investment experts will always know the customer needs certain things. There's always a divergence between what the customer wants versus what the customer needs. It's like certain things appeal to a customer. For instance, he may not have the kind of money to reach him to his financial goals next number of years down the line. So hence you need to know very clearly what to calibrate his risk, what not. But at the same time, the customer wants to hear certain things from you. He wants to hear this. He always relates to people who probably kind of resonate what he has in mind. So this is where you require tact. So good ability to understand the customer, good ability to understand boundary conditions that the market puts on you, and try and see how best you can mix and match these two. Because please understand, unlike in other industry where value add becomes very tangible, if you're working in a steel industry, right, you have an input form and an output form. Whereas unfortunately, money management is one industry where input form and the output form remains the same. A good customer always keeps confusing between brains and bull market. In a bull market, right, you will say, well, anybody would have done this. In a bear market, you also know it's not something. So risk reduction is something which unfortunately customers don't really appreciate. So you need to get the skill. Communication is actually at the very basis of all these things, and your ability has to be to understand the customer and to set boundary conditions. Because this business is all about making the customer persist with his investment in bad times. If you see merit, all that you need to do is to make your customer persist with that investment in bad time if you believe it's a good investment. That requires a lot of tact, communication, skills, all these things. So that's what is more important in this business. A very simple thing, you could do this for yourself. A lot of mutual funds are sitting on, say, a large part of the AUM and equity. If you were to go back to 2003, 2004 and just take the AUM that they sat in 2004 and just indexed it to your current markets, you'd be surprised to see that 80-90% of them would probably not be even leveling up to that. So which essentially means, you need to make sure that customers stick to their investments in bad times. That's the most important thing. Trying to kind of sell the investment in the worst market is actually the worst thing that could happen. So that's where you need to kind of develop that skill, understand your customer a lot more, try to temper him in good times. Because you don't win this business. See, a lot of this income products that you kind of deal with for the customer has annuity element in it. Because, act of selling is once, but your income comes over the next 20 years, 30 years, and as long as the customer stays invested, you keep getting money from it. So the longer you make him stay, the better it is for you. So you need to kind of find out what is good for the customer, so he stays long.
Any other questions, guys? Anybody? This is a question I'm going to get feedbacks for, but Bitcoin, what do you?
I am not expert in Bitcoin, but my thing is, see, currency is something where you gain legitimacy through a legal structure, regulatory structure. That's the understanding which I come with. It's enforceable, right? You cannot refuse a legal tender. Bitcoin does not have it, except for a few countries that are adapting it. At best, it can be a store of value. The way your art is the way your gold is. It can at best be a store of value. I wouldn't compare it to gold. Gold has been around for a much longer period than Bitcoin. So at this point of time, it's more like a store of value, like an art. For a painting, you assume it's worth about 30-40 crores. It's more than Bitcoin. People think it's worth so much. That's my understanding. So, but
Do you recommend a career in crypto or NFTs for?
I don't think I have an understanding on that space to kind of recommend. But see, a lot of us in the investment business are also kind of tempered by our own limited understanding. Sometimes what we understand is where we can put money. There's one way to say I keep working on to improve what is my level of understanding. But second is also to kind of you need to always invest in something which you at least know why you're losing money for. Perversive way of putting it, but at least you need to know what is happening, why are you losing money. If you put money in something which you don't even know why you're losing money for, is So moral hazard more than
Very well put.
And second is, experience. This industry is something where you would see with every cycle and every crash, survivors get to learn a lot more and probably become much, battle scars are what kind of gives you wisdom. Knowledge is what comes, from your textbooks. So knowledge confluence with experiences is what gives you wisdom. So every time you kind of go through one cycle, second cycle, and third cycle, you will get better and better and better. And there will be cycles. There will be cycles. As much as you want to attribute linearity to it, put a 100-year trend and say, look, it's almost linear. Within those countries, there will be cycles.
Last question from my side, unless there are, yeah, please go ahead.
So we have seen that ruble is at the strongest in last 2-3 years. I mean, this is mainly because they cannot import as much as they are exporting. So current account surplus is way higher. What opportunities do you see in Indian markets that could cater to the needs of Russia or that sector?
See, currently ruble is not a freely traded currency. Right now, there's a lot of restrictions happening. It's very difficult to kind of trade on ruble. It's a very, very geopolitical currency at this point of time. Second is, I'm sure in economics you all have covered something called as commodity currencies, Dutch disease. So whenever a particular commodity, which a country kind of holds on to, the commodity does very well, the country's fortunes kind of get linked to the commodity a lot. So the currency strengthens, the stronger currency kills other industry. Right? The stronger commodity kind of makes the currency stronger, that kills other kind of businesses in the country. So it's what you call as Dutch disease. So is a stronger currency really good for Russia? The answer is no. But it's very difficult to plan trades for these kind of moves, primarily because all of us know Russia is a very complicated currency at this point of time. And it's always been complicated. This is not the first time we are going for adjustment in Russian ruble.
I guess his question is, does India have an opportunity with Russia being the way it is geopolitically?
See, India has been moving west. My understanding is we are moving west. So where are we allied to Russia? We are allied to Russia because 30-40 years back, US wouldn't supply high-tech weapons to India. US was more tied to Pakistan and we had to go the Russian way to get our source our weapons. While incremental new weaponry is largely moving west, but for the stock that we have, we still have to lean a lot more on Russia for existing spares and support and all that. Right? So that relationship is going to take a longer for us to kind of struggle. But I would think 30-40 years down the line, we'll definitely be much more marginalized than what we are. Tilt is very clearly more towards west. That's my understanding.
Other questions? The last question from my side, and then we'll let you off, please. One good trade or call you're proud of. I know you're a humble person, but I just want you to. And one call you're not so proud of.
All of us kind of want to predict than to preempt. Right? There's a lot of fashion about it. Imagine if you are sitting in a very rash driver, you all want to kind of predict when he'll meet with an accident and try and travel till there before you jump off. But in reality, that doesn't happen. Right? I guess when you talk about, as much as you talk to humble people in finance, they always talk about winners and they don't talk about losers as much. But yeah, I mean, see, our fixed income calls have been reasonably okay. I guess we did take this bold call in 2018 as a leap of faith to kind of extend our maturities and duration. That kind of worked very well. At that point of time, when we kind of started investing, there were very few people as a starting point who would say, okay, look, it's a good time to invest. And things were looking so bad on 2018 September, post ILFS and all these issues. So we started padding up and going long at that point of time. That kind of worked very well. And it worked very well for two reasons. One is we invested largely, we are full taxpayer entity. So for me, post-tax return is what is very important. We had to kind of go in 2018, which gave us the flexibility to exit in 2020 when rates were at a low. So I could invest in 18 when rates were at a high. And by design, 3 years later, I could exit when the rates were low. Imagine if only I had invested in 2019, right? my exit should have been not as good as 2021. Because we are talking about 21 to 22, interest rates have gone up by almost about 400 basis points. So that on the hindsight looked reasonable rate. But then see, doing well at a portfolio level is not about having winners versus losers. It's about how much you have on those winners as a percentage versus how much you have on losers. That's what distinguishes, right? You might have those brilliant investments that you have made, but if those investments are very small sleeves. So that's one was satisfying experience for us to see that. Once again in 21 we were very low on duration, largely on future. I'm sure thanks to people like him, we kept leveraging to a large extent. You require to kind of seek opinions at the point of time from market makers and movers. We kind of read this. That trade was ILFS. Most of us saw it coming, right? We saw the ALM mismatches kind of filter through, manifest. We saw markets were giving a spread which was not reflective of what the rating agencies were giving. The rating agencies were giving opinions basis the level of ownership and the kind of shareholders. See, ratings have shifted more behavioral than financial. And that was, the writing was on the wall to some extent, but then it kind of, see, in Indian markets, another thing is course correcting a mistake is very difficult. Once you kind of enter in and make a mistake, to kind of undo that mistake is very, very tough, and especially in credits. When you kind of give a loan and you start seeing the business is not doing that well as you had, you need to cut it very early and move on. You kind of wait till it festers, it's very difficult. So course correcting mistakes in India are, I'm sure you know them better. Well, yes, it's like your Bombay suburban train traffic. The people are on this side of the platform, or they are all on that side of the platform. So either everybody is there to buy or everybody is there to sell. That's how Indian markets are.
Great. Any other questions? One for the road?
Sir.
Yeah, good.
So as you mentioned, the asset liability mismatch. Now with aggressive interest rate hikes, do you see a similar asset liability mismatch for NBFC companies happening in future?
Infra NBFCs are different. Infrastructure NBFCs are concerned, they lend long term and they were borrowing short. Normal NBFCs don't have longer term assets. Housing companies are the only ones who have longer term assets. But even there, if you look at it, their interest rates are actually reset fairly shortly. So it's not unlike in the case of ILFS, where he was borrowing money largely for 1 year, 2 year, right, and lending money for 10 year and 15 year. That's not the case. So NBFCs, consumption financing NBFCs don't have maturities of more than say 18 months or so. Microfinance are about 12 months to 18 months. I think that is reasonable. And since we are all coming from those air pockets and shocks, see, experience is also much more reflective in the near term. Kind of regulations also evolve. If you look at it, we moved from SLR to LCR. LCR is post global financial crisis. Right? So every time when regulations come up, you go back to what shaped those regulations. The backdrop will give you a much more understanding. So some learning from ILFS crisis, right? Then made it fitter worthy for some of these large NBFCs. RBI is also kind of graded NBFCs based on their size, systemic linkages, right? All these things have sanitized the system. Because most important, right? Corporate India's leverage levels are at an all-time. Your interest coverage ratios of businesses in aggregate are much more robust. So the impact that it could cause today is much different from the impact that it could have caused in the past.
Thanks a lot, Sriram. I really appreciate this. A few quick takeaways as far as I'm concerned, and I'm sure there are plenty others that others have taken. One is notice that he still hangs on to theory. The number of times he referred to theory, so don't lose that. If you've read stuff in SAPM, if you read stuff in economics, it's important to have that bent even in a practitioner mode. And by the way, this is true for every single successful practitioner that I have come across. They will tell you theory very, very nicely. Second is the breadth of knowledge across different, and especially in an investment job. I think I mentioned this thing about doing adda, right? You have to know lots of things about lots of areas to actually be a person in markets. Third is the humility. Guys who manage such large sizes, the other guy I used to bring for these sessions was Rajesh Raman of Diamond Asia earlier. So I'm not bringing Rajesh this time around. He's a hedge fund guy out of Singapore. Don't tell him I said this, but if you see him on the street, you'll think he's some roadside, guy walking around. One of those guys you find in the Mumbai suburban trains. He's one of the richest guys in Singapore, by the way. Done extremely well as a hedge fund manager. Brilliant calls. Extremely humble. So if you ask him how many times are you right, he'll say maybe 52% of the time. 48% of the time I'm wrong. He comes with that kind of an outlook, and he'll only talk about his failures, by the way. He'll never talk about his successes. They all come in the same mode, again, theoretically, very, very strong and very humble. Fourth, I really liked your point about focusing on what the market is baking in. The point about if 9 people are bearish on bonds and only one person is neutral and nobody is bullish, the point that you said about using that as an indicator to go long, as a starting point to think about going on the other side. It's a contrarian strategy, but it is a powerful strategy. Clearly, it has worked for you. I love this point about this 30%, 40% on equity. I know of many investors who follow this kind of a method of rebalancing on a dynamic basis. So it's in a sense being extremely aware of the markets, at the same time also being aware that it is difficult to predict markets, and don't try and predict markets, and instead try and go on the behavioral aspects and try and go on the money management aspects. Therefore having that humility again, very, very powerful. Plenty of other takeaways. And thank you again for coming down specifically for this, Sriram. I think SPJMR and this cohort specifically owes you one. We are also hoping that you come back and hire some people as well eventually. You're materially minded, of course, but generally appreciate this. I owe you one. Many thanks for doing this. Any closing words?
You need to kind of, as I was to say, the ability to blend. One is reading, and your ability to relate and apply is extremely important, because only when you relate to what you read and apply, you generally tend to retain these things for longer. Because as you go from cycle to cycle to cycle, you need to retain it. Every time you kind of shed and unlearn and relearn, it becomes very difficult. You need to kind of carry those experiences across and read a lot more wider. In fact, experience in the market kind of teaches you a lot more. Because the gold, Talib says this, that the gold standard in banking system is always Swiss banking system. Swiss banking system does not hire top down. It's largely grounds up. They hire people from 12th or UG, then they kind of put them to their banking system. You're allowed to take breaks, go and kind of go for sabbaticals, finish your PG, come back. So by the time you're around 30 or 35, you are good enough to lecture in a college which you're kind of studying. So being grounds up, you can relate to everything that's happening. So that is extremely important. That enthusiasm to kind of relate to a business, right? That is extremely important. And you would see that a lot of these things are connected with your textbook. The fact that sometimes people feel, what I've read is very different from what I'm doing in practice is because their inability to connect these two. The fact is they are connected. Frictions are there in markets. But by and large, you see that they are 80% they'll relate over a period.
Thank you. Thank you again, Sriram.